Hi guys. So if you're watching this in the future, it is 2/2/22. So that's when we're wearing this tie. If you're watching this in the future and you're like, why is Miss Grady wearing a tie? And that's why. I look good though. Look very businesslike because we're going to talk about some business things today. We're going to talk about the 2008 recession. You should have watched the video kind of introing the Great Depression. We'll talk a little bit about the Great Depression in these slides, but mostly it's going to be about the 2008 recession. So starting off, on Friday, I had this graph drawn up on the board, and it showed the price of pizza versus the number of slices available. And that was supposed to represent supply and demand. So supply is the amount of products that you have or that a company has, and demand is more of like the consumer. So the amount of people that want to purchase the product. So if you make a lot of one product, you're going to have an overload of supply, which leads to the price going down. Vice versa, if you don't have a lot of supply, if you don't have a lot of the product, the price will go up. So I use the example of like when the Nintendo, I only remember this because I was in on this, when the Nintendo Switch came out, everyone was sold out. So there weren't many left. And the people that had bought them and were reselling it, they were increasing the prices because there weren't as many Nintendo Switches. So that is just kind of an example. So like I said, if the price goes up, what happens to the demand? Sorry, my computer glitched out. But if the price goes up, the demand eventually will start to go down. Not at first because people want that product so bad. Some people want like the Nintendo Switches, people want it so bad. But eventually that demand will go down. So the equilibrium, that was the middle of the graph. Let me see if I can pull up that graph. This should be your guided notes that you should be filling out. The middle of that graph is the equilibrium. So if we're looking at this graph, the price of pizza on this side, okay, is $3 a slice. The quantity of pizza slices, $8. Okay, so the equilibrium is where the supply meets the demand. Okay, that is ideally what you would want. You don't want too much supply. You don't want too many people demanding the product. You want an equal amount so that you can, stay consistent and keep afloat, I guess. You want the equilibrium is the supply and demand are when the supply and demand are equal. Here we start off into the Great Depression. I have a bunch of memes, so just bear with me. I think they're funny. If you don't think they're funny, that's fine, but just trying to lighten things up because things are very sad. So when the Great Depression hits, we have a lot of people in debt. And what we saw in the last video, we were talking about the banks are failing because people aren't able to pay back their loans. So you see a lot of people owing people money and unable to pay those back. Herbert Hoover, the president at the time, doesn't handle the crisis very well. He gets blamed for the Great Depression, which is kind of unfair because it was a building of many different factors. He's just the one in office at the time, so they tend to blame the president in office. But he also does not handle the Depression that well. He immediately, when I think of Hoover, I think of the "this is fine" meme when everything is just crashing around them and he's just like, "This is fine." He really wanted to try and keep the government out of helping the people around the country. He thought that keeping the government out was in the best interest of American citizens. So I like this other meme. We've tried nothing and we're all out of ideas. It's very funny. Here's some quotes from Herbert Hoover. Let me see if I can move my face here. He was really big into pull yourself up by your bootstraps, meaning like you're on your own, you need to work, you meaning American citizens, you're on your own, you need to work to get back to prosperity by yourself. Another quote, it is just as important to keep business out of the government and that the government keep out of business. So once again, kind of like not a hands off, but almost. Did not want to provide government relief for people suffering from the Great Depression. Another one, economic wounds must be healed by the action of cells of the economic body, the producers and consumers themselves. He's saying he's leaving it up to the producers and consumers to get back on their feet. He was really big into volunteerism. He thought that if he encouraged volunteerism, meaning encouraging people to volunteer to help others, right? Kind of coming together as a country without the government's help. He thought that would work, and it did a little bit, not as much as he would have thought, I think. This last one isn't a quote. It just kind of sums up what he was saying. He's like, you're on your own, my dudes. Good luck, because the government's not going to help you. Here we have the Great Depression, the star of the Great Depression, FDR, Franklin Delano Roosevelt. One of my professors in college was like obsessed with him. And like rightfully so. He's an interesting fellow. Hold on one second. Hi guys, I'm at home now. The bell rang and then I wasn't able to record the rest of the video. So this is, the second part. You'll notice my really awesome messy bun. That's a little Easter egg you can look forward to in this video. So we left off with FDR coming in and doing the complete opposite of Herbert Hoover, helping people, giving government aid, where Hoover was like, the government's not helping at all. FDR creates what's called the New Deal. Basically does or creates a bunch of different government aid organizations to help people in need. So we're not going to go through all of them, but some things that you can write down that the New Deal accomplished are the first one being he passes an emergency banking act. And basically what he does is he shuts down the banks for around 4 days and has the government investigate which banks were solid and which ones the government can go in and help out, okay? Because we know banks were failing because of bad investments. This is kind of investigating why they failed. And so we're able to find that out with this Emergency Banking Act. Another thing the New Deal does is the passing the Security Act, meaning that when we talk about the stock market, when you buy stocks from a company, you're basically owning, I think it's like 0.0001% of the company. So just like a small percentage of the company. And back before this Security Act was passed, people were mainly buying stocks based on the name of the company, not really based on what the company was about. They didn't really have that information. It was basically just on the name. So what the Security Act does is it requires companies to give more detailed descriptions about the stocks so that people buying stocks know what they're getting into when they buy them. And then the last thing the FDR creates with the New Deal is the Social Security Act. This is basically a check that goes to people who can't work because of many different reasons, disabilities, or you get injured and you're out of work for a while. Okay, it's not a lot of money, but It's like a small check that's compensating these people who can't work. And it's still in effect today. Social Security is. And then this slide, I just wanted to address that Franklin Delano Roosevelt is seen as a hero of the Great Depression. A lot of people like to make it seem like he came in and fixed it all and he did it. But just like many other people that we talk about in history, people are flawed. People aren't always just good or just bad. So was Franklin Delano Roosevelt a hero in the Great Depression? Yes, somewhat, but not all of his policies worked. Okay, some of them definitely did help a lot, but not all of the New Deal was successful. So the unemployment rate for the 2008 recession was 10%, but it goes down to 4.7% during the Obama administration. So if you're writing this on your worksheets, okay, you can write 10%, but eventually goes to 4.7% during Obama. So now we're going to get into this vocabulary. So a loan is basically lending money to someone with the intention that the person will pay you back. So loaning out money so that somebody can make a purchase if they don't have the money right then, and then, but they know they will have the money in the future. Okay. It's kind of like a promise with, consequences and a dollar sign. So when we get into the idea of loans, we also have to talk about mortgages, which are specifically loans for a house. Okay. So how it works is if I were to purchase a house or decide to purchase a house, I would go to the bank to get a mortgage, take out a mortgage. And the bank would say, okay, we're going to give you this money, okay, to purchase the house. You're going to eventually have to pay it back. But until you pay it back, we are technically going to be the owners of the house. So they are keeping the paper that says Miss Grady owns this house until I pay off my mortgage. You might hear my dog snoring. She's right next to me. I'll show you at the end, but she is snoring kind of loud right now. So, but back to mortgages. So let's say that I hit hard times financially and I'm unable to pay my mortgages, my mortgage payment. I would go into something that's called default. Default is basically I stop paying payments and it leads to eventually the bank taking the house. Okay, because I'm unable to make those payments, I'm unable to pay them back. The house was theirs until I was able to pay those off. Okay, so they take ownership of the house. Then we get to this a little complicated, a little more complicated with this mortgage-backed security, which are basically investors who are coming in and buying multiple mortgages in a package deal in order to collect that interest money that I'm paying and that the bank is making money off of as well. So mortgage-backed security, you can think of it as somebody coming in and buying a whole pack of pop rather than just one can. So they're not going to invest in one singular person's mortgage. They're going to invest in a whole package of many different people's mortgages. So then we get to this idea of insurance. It's really, really important that as you grow older, you are thinking about getting insurance because unfortunately we live in a world that is not all sunshine and rainbows. And insurance gives you protection against possible loss. So for example, if I have car insurance and somebody hits me with their car, right, hits my car with their car and it's not my fault, my insurance will help me pay for the damages on my car. They won't pay it all, but they'll pay at least some of it so that I'm not in, crazy debt trying to pay off the repairs to my car, right? So I have the insurance league as this kind of joke. You don't get a superhero if you sign up for insurance. That's not one of the perks, but I just thought that was funny. I made that this morning. All right. So Then when we talk about insurance and mortgages, we have this idea of a credit default swap. And credit default swaps are basically insurance for mortgages, just in case someone's not able to pay off their payments and they go into default. So investors are able to get insurance on their investments in people's mortgages, right? In case something goes wrong, they'll get money back, right? They won't be hit very hard. So talking about the 2008 recession, we get into this idea of predatory lending, which is a really terrible thing that banks are doing at this point, which is basically they're telling people that they need to take out a mortgage with them, right? The bank, because it's at a low interest rate. And they're telling them, hey, come to the bank, take out a mortgage, buy a house. We're having a really low interest rate, so you'll be able to pay it off and everything will be fine. But unfortunately, right, these people who really can't afford to buy a house and should not be buying a house are taking out mortgages that eventually they won't be able to afford, because that interest rate starts out really low, but then it slowly starts to increase to a point where they're not able to pay it off. So they're kind of lying to them. They're saying, hey, we have this low interest rate, which is true, but then they also don't say that the interest rate will slowly or will increase to a point where those people won't be able to pay it. So this gets into the idea of also subprime mortgages, which are basically bad mortgages disguised as good mortgages. So for example, we have that case of mortgages, right? Just like that case of POP. That would be like one or two of those mortgages in that case are absolute garbage. We have these people who can't afford houses and can't afford their mortgage payments, but the banks and the rating companies that are rating these people's, credit scores and financial backgrounds are giving them good ratings, even though they're really, really bad. Okay. So just some more lies and deception. So this leads us into story time of the 2008 recession, putting all these vocabulary words together. So we have banks selling mortgage-backed securities to investors. These mortgages or these mortgage-backed securities, had insurance claims placed on them by insurers. Okay, so they're able, to be protected, like we've said. These insurance claims were called mortgage-backed security. The goal for these insurance claims was if the people taking out the mortgage had defaulted on their loan, then the investors who owned those mortgages would get compensated on those defaults. Okay, so a little bit of a review there. Then we get into investment banks beginning to stop caring who they give mortgages to. They just start giving them out to really anyone, trying to get anybody to take out a mortgage with them. And they start doing, like we've said, predatory lending, which was basically giving people mortgages that start off as low interest that they're able to pay and then increase to a high interest that they can't afford. They also stopped doing good credit checks on people. So they're not really checking if people are financially stable enough to eventually pay back their mortgage or buy a house. This meant that a whole bunch of people started buying houses that could not afford them, which is a problem. We have, like I said, rating agencies giving a lot of these subprime mortgages, these bad poison mortgages, a AAA rating, which is a really good rating, even though they did not deserve them. 75% of the mortgages were given a AAA rating, but 70% started to default, started not being able to make those payments on their mortgage. This created a flood of houses on the market, okay, because people are defaulting, they're not able to pay the mortgage. So the bank is taking their house and and selling it. Okay. So a bunch of these houses are going on the market because our people are defaulting all at once. So the more of a product you have, like we've talked about with supply and demand, the less that it's worth. Okay. So we have the supply being houses. The more houses we have, the less that it's worth, the less money they are worth, which means that homeowners prices, people that are selling these houses, are going down. Okay. So they may have bought the house for a bunch of money, but it is decreasing in value because there are so many homes on the market at once. Also at this point, banks are stopping giving out loans. People are taking their money out of the stock market because they can't afford their house. They sure can't afford the investing in the stock market. And the Dow Jones, okay, is dropped by 1/3. So the stock market is not doing too hot because of this, because people are taking their money out of the stock market. The insurance companies are unable to pay back the money that they promised through their credit default swaps, through their insurance claims. So the investors of those mortgage packs are losing money as well. It's utter chaos. The economy went into a free fall. The government passed legislation bailing out the banks with over $7 billion of the taxpayers' money. So once again, we see banks being bailed out by the government. That's a ton of money. It's interesting because, like, some of you were born at this time, some of you weren't even born. I was thriving, you know, as a child, and we had really no clue that any of this was happening in society. I just think that's interesting. So that it was the story of the 2008 recession. If you have any questions, let me know. You should have filled out that worksheet. That is linked in this post on Google Classroom. Open Notes quiz, bring that paper. That's the only paper you can use on it. And we'll see you. I'll see you when I see you. Oh, I'll show you my dog real quick. Let's see. Here we go. There you go. She's the one that was snoring. And now she's not making a sound. How convenient. All right. Bye, guys.